So usually medical diagnosis is like pretty precise. It's almost like engineering. You break your arm, the x-ray shows that jagged white line, and the doctor just points and says, there it is.
Right, it's completely binary. Like it's broken or it's not broken.
Exactly. And that visibility, it's comforting in a way. But right
Hmm.
now, when geopolitical analysts look at the global economy, the x-ray is, well, it's terrifyingly murky.
Yeah, the symptoms are definitely flashing red everywhere.
They are. But identifying the exact fracture point is just incredibly complex. So, welcome to today's deep dive. We are jumping straight into an urgent, honestly, highly intense YouTube interview today from the channel ITM Trading, INC.
Yes, featuring Gerald Celente.
Right, the publisher of the Trends Journal. And for you listening, as someone who likes to get to the actual bottom of overwhelming info without the jargon, this one is a lot to process.
Oh, he is absolutely not holding back in this interview. Not even a little.
Not at all. I mean, his core premise is that we are currently entering the scariest time of his life and that we're hurtling toward what he calls a greatest depression.
Which is a heavy claim.
Very heavy. So today our mission is to reverse engineer his economic thesis. We're going to look at the intersection of escalating Middle East conflicts, his forecast of a $130 oil spike, and this concept he calls the death of the dollar.
But before we get into his claims specifically about the U.S., Israel, and Iran, we really need to set a baseline here for the listener.
Yeah, please do.
This source material contains some very highly charged political opinions regarding historical conflicts and current leadership, and we need to be crystal clear that we are maintaining absolute neutrality today.
Yes, 100%.
We aren't taking sides or endorsing these viewpoints. We are merely reporting Celente's perspective so we can understand the economic thesis he's building.
Okay, let's unpack this. Because Celente's primary fear, basically the catalyst for this entire economic meltdown he's predicting, is an escalating war involving the U.S., Israel, and Iran.
Right.
And he is convinced, like firmly convinced, that this isn't going to be some localized, quickly resolved border dispute. He thinks it's going to be a prolonged conflict with massive global economic fallout.
Yeah, and he rests this prediction on some pretty stark numbers. He points at this massive population disparity to show why a quick military resolution is, in his eyes, impossible.
The numbers are wild.
They are. He notes Iran's population is roughly 91 million, and he compares that to Israel's 7 million.
Wow.
His argument is that just from a purely logistical standpoint, you can't simply overwhelm or occupy a nation of that size with their geography and tech without a massive drawn-out campaign.
And he brings up something deeply unsettling about how far that kind of escalation could actually go. He mentions Israel's Samson option.
Yes, which is widely reported as a last resort deterrent strategy.
Right.
Celente claims Israel possesses somewhere between 200 and 400 nuclear warheads, and he brings this up to underline the ultimate stakes here.
Because if a nation feels facing an existential threat, I mean, deploying that kind of arsenal isn't just a military escalation. No, it's a complete global paradigm shift.
Right. But, Israel's nuclear stockpile isn't the direct reason Celente thinks your 401k is going to zero. The bridge between a Middle Eastern war and a global depression is actually the supply chain.
Exactly. It always comes back to resources.
Because of this conflict, Celente is forecasting that the price of oil will abruptly spike over $100 a barrel, and he thinks it'll likely settle around $130.
Which is massive.
It is. So help me understand the mechanics here. I mean, obviously expensive gas is annoying for everyone, but does an oil spike really guarantee an equity market crash today? I mean, aren't modern markets a bit more resilient? Like, haven't we built up shock absorbers?
Well, what's fascinating here is the domino effect of energy costs on a highly leveraged system. Think about it. An abrupt spike to $130 a barrel isn't just, pain at the pump for commuters.
It acts as a universal, unavoidable tax on literally everything. Every single piece of plastic, every Amazon delivery, every server farm that powers the internet, they all rely on energy.
So it just destroys profit margins across the board.
Exactly. And Celente's view is that global equity markets will just instantly buckle, not merely because energy costs go up, but because the global economy is already incredibly fragile underneath it all.
Like it's built on a shaky foundation.
Precisely. Corporations have spent the last decade borrowing massive amounts of cheap money. They are carrying enormous debt loads. So if you suddenly crush their profit margins with an energy shock, they literally can't service that debt.
Oh, wow.
The oil spike is basically the final seize up in an engine that is already running on fumes.
Okay, so the conflict triggers the oil shock, and then the oil shock triggers the debt crisis. But why is Celente so totally convinced this conflict is unavoidable? Like, why it assumes there's no diplomatic off-ramp where leaders just, sit down and de-escalate?
To understand that, we really have to look at his underlying philosophy of governance. He calls it political atheism.
Political atheism,
Wow.
right? He proudly declares he just doesn't take political sides at all. He views basically all modern leadership as what does he call it, a political crime syndicate.
Yeah, he's an equal opportunity critic, for sure.
Totally impartially lambasting Trump, Biden, Obama, Bush, Clinton. He essentially says they all operate from the exact same playbook, no matter what they claim on the campaign trail.
And he provides a very specific historical origin story for this worldview. He points directly to the year 1953 in Iran. This is the absolute bedrock of his skepticism.
Right. He goes really deep into the U.S. and U.K. overthrow of Iran's democratically elected leader, Mohammad Mossadegh. And according to Celente, the reason for this coup was purely economic.
Yes, Mossadegh wanted to nationalize Iranian oil.
He basically said the resources under Iranian soil should profit the actual Iranian people.
Right, and that was completely unacceptable to the foreign powers who were controlling those resources at the time. Celente asserts this overthrow was orchestrated specifically to protect corporate interests.
Specifically, Anglo-Iranian oil, which we know today as BP, and Standard Oil, which is now ExxonMobil.
Exactly. Celente argues it had nothing to do with spreading democracy. It was strictly about maintaining control of the global energy supply, and the result was the installation of the Shah and the creation of the Savak secret police.
Which he notes was notoriously brutal.
Extremely brutal.
So jump forward a few decades. When the Iranian Revolution happens in the late 1970s, Celente is watching the news and realizing that the narrative the public is being sold is vastly different from the geopolitical reality of resource control.
Yeah, that was a pivotal moment he started investing heavily in gold and oil futures.
Makes sense.
He matches this specific 1953 event to a broader, much darker pattern that he perceives in government behavior throughout the 20th and 21st centuries.
The false flag theory.
Exactly. He argues that when domestic economies are failing, governments deliberately provoke conflicts to distract the populace and reboot the financial system. His exact phrase is, when all else fails, they take you to war.
And the examples he uses to back this up are honestly intense. I mean, he points out that the dot-com bust and a looming U.S. recession directly preceded 9/11.
Yeah.
And even more provocatively, he connects the Great Depression to the attack on Pearl Harbor.
Right. Let's look at the mechanics of that Pearl Harbor claim, because it's central to his argument.
Yeah.
He points out that in July of 1941, the United States, the UK, and the Dutch didn't just express, political disapproval of Japan.
They took massive economic action.
Huge action. They cut off 3/4 of Japanese foreign trade, they froze their financial assets, and most importantly, they cut off 88% of their imported oil.
There is that oil connection again?
Always oil. Celente's thesis is that if you back an industrialized nation into a corner by completely cutting off the lifeblood of their economy, a violent retaliation like Pearl Harbor is the expected, predictable, and maybe even intended outcome.
Because it forced the U.S. into a war economy.
Exactly,
Yeah.
which ironically is what actually pulled them out of the Depression.
I do have to push back just a little bit here, though. I mean, looking at history strictly through the lens of pure resource control is deeply thought-provoking for you listening. And it definitely strips away that patriotic gloss we're used to in history textbooks.
Absolutely.
But I wonder if Celente might be confusing historical chaos, bureaucratic incompetence and just intersecting crises with these orchestrated master plans. Is every war really a calculated mustache-twirling distraction from a failing economy? Or are leaders sometimes just making terrible reactive decisions in real time?
It's a vital question. Pattern recognition is an incredibly powerful tool for an analyst, but it can absolutely lead to seeing connections that are coincidental rather than causal. However, whether it's a deliberate master plan by a syndicate or just the chaotic flailing of a failing empire, Celente's core warning honestly remains structurally sound. Resource wars and severe economic downturns are historically interlinked. You rarely get one without the other.
Okay, so if governments are willing to go to these extremes, whether through malice or just pure incompetence to maintain control of resources, what does that actually mean for our domestic economy right now? If that $130 oil spike hits, what are we really looking at?
We're looking at a very specific, very unpleasant economic environment that Celente calls dragflation.
Dragflation. Okay, let's clearly define the mechanics of that for the listener, because we all know inflation is when prices go up, eroding your purchasing power, right?
Yes.
And stagnation is when the economy stops growing and unemployment rises. But dragflation is worse. It's declining economic growth actively dragging down the economy, coupled with rising inflation.
Yeah, it's a vicious cycle.
It's an active undertow. Your wages are shrinking, opportunities are vanishing, and yet the cost of basic survival just keeps shooting up.
And the mechanism driving this dragflation today, in his view, is what he calls a dot-com bust 2.0. But the scale is entirely different this time.
How so?
Well, in the late 90s, you had retail investors buying into, like, pet supply websites with zero revenue. Today, the bubble is rooted in massive systemic overinvestment by private equity groups, particularly in the tech and AI sectors.
Right, and he gets really specific about the liquidity crisis happening right now behind closed doors. He mentions that private equity investors are panicking.
They are.
They want their money back, but the cash just isn't there to give them. He claims they're only getting small percentages, like 5%, returned to them when they actually try to cash out.
Yeah, that's a huge red flag.
He even cites that the credit rating agency Moody's recently downgraded firms like KKR to junk status.
And we should explain why a downgrade to junk status is so catastrophic. Because it's not just a bad review on Yelp.
Right, it triggers actual mechanisms.
Exactly. Many large institutional investors think pension funds, insurance companies, they have strict legal charters that forbid them from holding junk or non-investment grade debt.
Oh, wow.
So when a major private equity firm gets downgraded, it triggers forced automatic sell-offs. Institutions literally have to dump the assets regardless of the current price, which crashes the market further and dries up liquidity even more.
To put this into a real-world metaphor, it's like private equity took out a massive, high-interest, hard money loan to flip a mansion. You think you can renovate it with AI and sell it for double, but suddenly interest rates spike and the entire housing market just freezes.
Yes.
You can't sell the mansion, but the bank still demands their 15% interest every single month. You might look rich on paper because you own a mansion, but you are completely illiquid. You have zero actual cash.
That is exactly the dynamic. And to highlight the severity of the U.S. position, Celente contrasts this chaotic, debt-fueled private equity struggle with the incredibly systemic approach of China.
Yes. He notes a staggering statistic here. He says 25 years ago, when China entered the World Trade Organization, only 10% of their 18-year-olds went to college.
Just 10%.
But today, he says it's nearly 70%. And that massive wave of human capital is heavily, systematically directed by the state to focus specifically on artificial intelligence and engineering.
If we connect this to the bigger picture, just look at what we've built. You have a massive over-leveraged debt load in the U.S. private equity sector that is totally illiquid.
Mm-hmm.
You have a government continually increasing the defense budget and the national debt.
Right.
And you have a geopolitical rival strategically playing the long game with human capital. This creates an incredibly precarious house of cards. Now, introduce a massive geopolitical conflict in the Middle East that triggers a $130 oil shock.
The wind from that oil shock just easily blows the entire economic house of cards down. The margins collapse, the debt can't be serviced, and boom, you get dragflation.
Yeah.
So if the economy is this massive undertow and private equity is completely illiquid, what is the actual life raft? Like, with equity markets faltering, how does Celente suggest you protect yourself? And what does he think the government is going to do to try and maintain control as things unravel?
Well, this brings us to his concept of the death of the dollar. Celente is extremely bullish on physical gold and silver. He sees them as the ultimate historically proven protection against the collapse of fiat currency and the ravages of inflation.
But there's an incredible anomaly in the source material here that I really want to highlight because it completely reframes how markets actually work during a panic.
Oh, the gold drop.
Yes. The interviewer points out that recently, despite all this terrifying global news and rumors of war, the price of gold actually briefly dropped, which seems totally counterintuitive. I mean, if the world is on fire, shouldn't the ultimate safe haven skyrocket instantly?
It's a brilliant observation, and Celente's explanation reveals the hidden plumbing of a financial crisis. He explains that gold didn't drop because investors suddenly lost faith in it as a store of value. It dropped because of a severe liquidity crunch in the broader markets.
Okay, walk me through how that actually happens practically.
Well, remember that dot-com bust 2.0 we just talked about.
Mm-hmm.
Investors are losing massive amounts of money in failing equity markets. And many of them buy stocks on margin, meaning they borrowed money from their broker to invest.
Right.
When those stocks tank, the broker issues a margin call, demanding cash immediately to cover the losses. But the investors don't have cash. So what do? They have to sell whatever they can find that is highly liquid and actually holds its value.
Wait, so gold wasn't dropping because people stopped believing in it. It dropped because it was literally the only asset they could successfully liquidate to pay off their other burning debts.
Exactly.
Wow. It's like selling your pristine, fully functional lifeboats just to pay for the gaping hole in the hull of the Titanic.
Yeah.
That is a massive aha moment about how financial contagion actually spreads. Good assets are sold to cover bad bets.
It is. But accumulating physical gold is only half of the equation for Celente. The other half is recognizing what he sees as the ultimate threat coming from the government, the transition to digital currencies, like stablecoins or a central bank digital currency, often called the CBDC.
And this is where his economic forecasting intersects directly with his fears of a surveillance state. He warns that a fully digital currency isn't just about, convenience on your phone. It's a mechanism for total, inescapable tracking.
Right. Think about the national debt. It is astronomical. The government desperately needs consistent tax revenue just to service the interest on that debt. If physical cash exists, there is always an off-the-books gray economy. But if every single transaction is mandated to be digital and routed through a central ledger, the government knows exactly what you spent, where you spent it, and they can algorithmically ensure they extract every single penny of tax owed before you even see the money.
This raises an important question about the centralization of power, and Celente contextualizes this by drawing a really fascinating parallel to the 1996 Telecommunications Act.
This is a crucial historical touchstone for him. He argues that before that act was signed into law, there were thousands of independent, locally owned radio and TV stations across the country. Information was decentralized.
Right.
But the act deregulated the industry, leading to massive, rapid corporate consolidation.
He actually states that today, just 6 massive companies control roughly 92% of the media landscape.
Exactly. He's explaining the mechanism of control. Control of any system relies on choking its distribution points. With media, deregulation allowed them to buy up the distribution stations. He argues that what they did to the airways over the last 30 years, centralizing the flow of information they are about to do to the flow of money through digital currency. They want to centralize the ledger.
Here's where it gets really interesting for you listening. Think about that tension. The government and the banking sector are moving toward total centralization and digital tracking of your money. Meanwhile, Celente is advocating for the ultimate decentralized, physical, off-the-grid asset, gold and silver.
Yeah.
But in a future world that is entirely digital, where every transaction is tracked and monitored by an algorithm, does holding physical gold actually keep you safe? Or does it instantly flag you as an outlier, an outsider, to the system they are strictly enforcing?
It's the ultimate paradox of preparing for a financial reset. The very asset that preserves your purchasing power outside the digital system might also make you a target within a hyper-surveilled economy. If you can't buy groceries with a gold coin, because the grocery store only accepts the digital dollar, the gold's utility becomes incredibly complicated.
So what does this all mean for you, the listener? Let's take a breath and recap the intense sequence of events we've just walked through.
It's been a lot.
We started with the threat of a Middle East conflict spiraling out of logistical control, which acts as the geopolitical trigger. That conflict chokes the supply chain, triggering a $130 oil shock.
Right.
Then we explored how that energy shock acts as a wrecking ball to an already fragile, debt-laden private equity market, forcing liquidity crunches and leading to dragflation, where the economy actively pulls you under while the cost of living shoots up.
Yeah.
And finally, we looked at the proposed government solution, total financial tracking through digital currency, while physical gold remains the ultimate, albeit complex, escape hatch.
You might be listening to this and vehemently disagreeing with Celente's historical interpretations, or his timeline, or his absolute cynicism regarding political leadership. But understanding this specific worst-case scenario is crucial. It acts as a stress test.
A financial fire drill, basically.
Exactly. If your personal finances, your investments, and your career skills can theoretically withstand the shockwaves of dragflation, an energy crisis, and a liquidity crunch, then you are robustly prepared for whatever lesser disruptions actually happen.
Right.
You don't have to believe the building is going to burn down to see the value in knowing where the exits are.
And that leads perfectly to the final piece of advice Celente offers in the interview. Faced with what he genuinely believes is the scariest time in his life, staring down the barrel of a Greatest Depression, his ultimate advice wasn't just to hoard silver or buy a bunker.
No, it wasn't.
It was to get into the absolute best possible shape you can physically, emotionally, and spiritually. Because weathering a storm of this magnitude requires a highly resilient human being, not just a resilient investment portfolio.
It's a powerful reminder that true preparedness extends far beyond the financial realm. When the macro systems fail, your internal systems are what you really have to rely on.
Which brings me back to where we started, thinking about that murky geopolitical X-ray. I want to leave you with a thought to mull over, something outside of Celente's direct quotes, but inspired by his warnings today.
Let's hear it.
If our financial systems do become entirely digital, centralized, and algorithmically trackable, and if global supply chains continue to fracture under the weight of conflict, resource wars, and dragflation, will the ultimate, truly untrackable currency of the future actually be gold? Or will it simply be community?
Oh, wow.
The physical, local trust we build with our neighbors to trade, support, and survive when the top-down systems freeze up.
That is a profound question to end on. When the digital ledger goes down, the human ledger is all that remains.
Thank you so much for joining us on this deep dive. Keep questioning the narrative, keep looking for the connections, and we will see you next time.